SoFi just came out with the Q4 earnings for 2021. Let's look at the numbers, let's look at the company metrics, the financial metrics, and the valuation, of course, as always. If you're new here, I'm Robert, welcome to my channel. Here we look at stocks from an unbiased perspective, looking at the pros and the cons as well. Consider subscribing and liking the video, but let's get into it. So at first we want to look at the members growth, which is obviously very important for SoFi and for their app. So this is the first slide of the earnings report. We had a record number of members growing in the last quarter of 523,000 compared to last quarter where we only add 39%. This time around we add significant amount, adding up to a total number of 3.5 million users, new members as they call, for the year for 2021, which represents an 87% year-on-year growth. And you can see from quarter to quarter since 2019 this number just keeps on growing, and especially in 2020 and 2021 there's an exponential aspect to it. As you can see here, it was more flat and consistent. Now we have quite a huge spikes here. And the last quarter of 2021, where obviously they made a lot of like ads and things like that, and a lot of campaigns to draw the attention to them, we did see a record growth. And this is obviously something well done by management and represents that SoFi is a product, an app that is really loved by its community as well. And then if we go to the next slide, we do have the lending products and financial service products. So we do see there is definitely a trend here developing that's quite wanted by the company, and that is the lending products on the left side, financial services product on the right side. And we do see that the financial products are growing exponentially, 155% year-on-year growth, versus lending products still decent growth, but more consistent and more in line with the previous years and previous quarters. 18% growth here to 1.1 million versus 4 million for financial products. So we do see an exponential growth curve. And why is this wanted by the company? That's the question. So obviously financial products, so such as crypto investing, other investing like stocks and others like savings accounts, those types of customers and members are much more easily to get for the company, and the customer acquisition costs for those are way lower. So to offer that broad range of products to them will be a good opportunity to get those members on board, and then eventually move on to the lending products, which are usually higher margin, which the company makes much more money on that interest rate that they can charge on to the member. So they're trying to get them with the cheap products, the cheap investing products, trying to get them onto the platform. And once they are on the platform, once they love the platform, as it's a one app, super app solution, and this is what SoFi is aiming for, the lending products will come as a second, So basically, once you're on it and once you're used to it and once you've adapted SoFi as your daily banking app, might it be through investing or just a normal cash sort of checking account, then you might consider getting onto the lending products and taking those on as well. And they absorbed all your customer costs already, because your customer acquisition costs were quite low from the financial service perspective. But now they're getting the benefit of a high cost customer acquisition products, such as the lending products like student loans and car loans, personal loans, and so on. So this is why they have been developing, they've been focusing on the financial products as well. And you can see that the mix here, so on the left side we've got Q4 2020, so 1 year ago, versus Q4 2021. So overall the whole product scheme and the whole product suite has developed. And obviously, as we've seen just before, this is representing here the financials versus the loan products. So we have personal loan, student loan, home loan, and then we have other financial products here: investing, money management, relay, and cryptocurrency. And we do see that the proportion here has increased overall. Obviously we have an increase, but also the financial products here making now making now 4 times the amount of the loan products for SoFi, which was around double 1 year ago. and now it's quadrupled basically. In terms of the financials, in terms of the guidance, we want to look at that obviously as well. So we do have the actual figures here for revenue, adjusted EBITDA and adjusted EBITDA margin, and we have the guidance here on that side from low to high. We do see that basically they were in line with expectations, so we were in the midpoint between low and high. For revenue, for adjusted EBITDA, so basically earnings before interest, tax, depreciation, amortization, we have the adjusted EBITDA as an actual coming in at 5, and we had expected something from 2 to 5. So we are in line, but we are in line with the higher guidance, so which is a good sign as well. And EBITDA margin, we were expecting 2%, and we were expecting 1 to 2%, and we actually made a 2%. So we're also basically in line here. So not a huge surprise as such to the upside. But what's obviously very important is the Q1 and the 2022 guidance, financial guidance from management. So we do see that adjusted revenue for the next quarter is pretty much in line with this quarter actually. So we had 280 million, and we do expect the same from a low, and then the high we expect 285. So not a huge growth there. But from a year-on-year perspective, it's still representing a over 30% growth on the top line. Adjusted EBITDA, we're expecting basically 0 to 5, margin 0% to 2%. And as a non-cash item to call out here, we have stock-based compensation ranging from 80 to 85 million, which is stock that gets issued to the employees for them to cash out later if they want to, but it's in their contracts basically. And we've seen that with a lot of tech and high growth names out there, that stock-based compensation has just been increasing over the past years to just be able to keep and retain that talent in that company. And we obviously don't want that to be a huge issue or huge deal for the company. At the moment, it is quite a big number. If you think about, this is the quarterly number, 80, and out of 280 revenue, we have 80 representing stock-based compensation. So it's a huge percentage of the overall revenue. So think about what type of revenue, if this was to remain consistent, what type of revenue has the company to make and then lower their cost to still be able to have such a high number of stock-based compensation. So obviously we want that to be more of a one-off expense and not something they're gonna just add on to the P&L on a consistent basis. So we gotta watch out for that next few quarters, how that's gonna play out. From a year-on-year perspective for the 2022 guidance for the entire year, we do see here adjusted revenue from 2019, actual 2020, 21 to 22, and here we had really nice growth. I mean, representing 87, 40, 60, and now we're assuming to have a 55% year-on-year growth for the next upcoming year, which is still very impressive growth. As the numbers obviously increase, that growth percentage is expected to decrease. So to keep it at that high level is really good to see. Basically adding half of the revenue on top to the 2022 revenue, and then adjusted EBITDA as such, we do see nice development here. That's what we want to see, starting off with a huge loss in 2019 and now guiding for 180 million profit on an adjusted EBITDA basis, representing an EBITDA margin of 11%. That obviously in that profit number, as you know, or as you might not know, SoFi has just been accepted to grant a banking license for one of their subsidiaries. So that's going to mean is that they're going to turn into a bank. They're going to become a bank. They're going to have access to money on the money market, can basically loan money to their customers that they have just acquired themselves, and basically offering way lower interest rates, which should in fact impact the EBITDA margin, which is, I think that's one of the reasons why we have that significant spike here from 30 to 180. I mean, that's quite a huge spike. If you think about 150 million, that's almost one of their quarters, so it's almost like 60% of one of their quarters, just added to the EBITDA profit line. And I think most of it will come from the benefit of having that banking license, being able to obtain money at a cheaper rate, charging it out to the customer at obviously higher rates, but maybe even still lower rates than their competitors, as they have the benefit of being completely online and being just an app platform, plus also then offering maybe better savings rate as well. So now that they have access to the cheaper money, they obviously want to offer their customers, they want to benefit their customers as well from that, so that more people will join the board, obviously. And so that's what's going to increase the revenue from a volume perspective, and might get lower interest income per customer. But if we then have more customers coming on board, it's still going to make a significant benefit or significant impact on the net profit margin. And this is what we're seeing here as well. We do have stock-based compensation, so we just talked about, and they're actually expecting a spike. So they're expecting 340 million compared to 240 million in this year, in 2021. So this is definitely something that is quite alarming. I mean, we have one quarter being around 280 million revenue, and they're basically giving away 1.25 of a quarter for stock-based compensation only. So, and that only leaves them with less than 3/4 of revenue to generate enough income, net income, for their shareholders. So I would have to go into the details here and dig into a bit more. So I would suggest you do the same, because obviously that's not something we want to see just keep growing over the years. We want to see that at some stage being consistent, or even trickle down, as most of the high value employees have been acquired. So next we're going to look at the price action for SoFi stock. What has the stock been doing after these earnings have been released, but also for the past year, obviously. And we want to look at the valuation. How does it compare to other competitors, but also from a standalone perspective, is SoFi stock cheap right now? So I pulled up the chart right now. We're looking at a $10 US dollar price, which is the exact price that this stock has obviously been IPOing via a SPAC merger. So they merged with an existing holding company that was already public, and they usually trade around that $10 valuation or $10 price per stock. And this is exactly the price that we have reached now in the past few days. And when we look at when was the earnings came out, we did have a spike here. I think the earnings came out around this time here. We did have a spike up, but then following really sharp decline to even below 10, below their IPO price, which is mainly caused by macroeconomic factors that we have right now going on. Obviously, we have worries about interest rate and inflation going up. We do have the Ukraine-Russia war situation going on as well, causing a lot of uncertainty in the market. So this is the main reason why it's been dropping out. There was no negative news whatsoever after the earnings, and investors actually positively reacted to the earnings, because they've seen that strong growth that the company has been consistently making for the members, and obviously that positive EBITDA margin that's been projecting for next year, plus 50% revenue growth. So we do have strong expectations, strong guidance coming from management, showing just their confidence in the product and in the company, and which led to that initial spike of around, I think it was around 20% or so, and then sharp decline the other day, following by another sharp decline. So now we're looking at the $10 price, which represents a market share or market cap of around $9 billion. We do see short interest is up around 12% at the moment, which is also interesting to see that compared to where we were a year ago in February 2021, where everyone was piling into high growth stocks, and a stock like SoFi just went completely crazy and went all the way up to around $25, $26 at the peak, which represented obviously a crazy valuation for the company back then, but even now would be And since then it has been coming down, reaching, trying to get up to that level again and again, showing the kind of the popularity of the stock, but never reached that. And obviously the last few months, for all the macroeconomics factors, have really been causing it to just consistently drop down. And now we do see that short interest, the same way as we saw people hyping in and building long positions in those types of stocks. These types of growth fintech stocks now get actually the most of the short interest of the market, because if something keeps going down, people just assume they keep going down. It's the same way when something keeps going up, people assume, well, now it's 25, or will probably go to 35 when they have their bank charter. We saw all these articles, we saw all these this thinking in the market, and now they're basically thinking, well, it's been dropping to 12, now it's probably going to drop to 10, next week it's probably going to be at 8. So people just assume that whatever happens in the recent months, it's going to happen again. So that's why the short interest is also high. And if we look at the valuation, which at the moment we probably want to look at the price to sales, as they're just being profitable, slowly being more profitable at the bottom line for now. So we still want to look at the price to sales, as they're growing at a rapid rate, and obviously they're not expected to be slowing down that growth anytime soon. So price to sales would be an appropriate measure here to look at. And when we look at the graph here, we do see that since June 2021, the stock has been always trading at around a 15 to 16 price to sales ratio, then had a sharp decline, followed by some sort of try to get back up to those levels. We were reaching a 15 price to sales ratio, but now really low, almost a third of that. We are at 6 price to sales ratio of 6, which seems to me very cheap for the amount of growth and potential that the company has. And I don't think that, the news about the new bank charter came out around here, like beginning of January, which everyone thought this would be the catalyst for the stock to really explode and be, because obviously the bank charter had projected EBITDA margin or EBITDA total to actually double from the effect of having the bank charter. So we would have expected that the stock would actually, goes crazy on this news, but obviously the macroeconomic factors weighed heavier on this stock, so the market has been discounting this stock even further. And now we're looking at a 6 price to sales ratio, which to me looks like quite a good deal. And looking at any other competitors, there's not really much out there, but the other fintech names are listed down here with their price to sales ratios. So we can see that something like Adyen, which is the Dutch-based fintech company, is trading at a 33 price to sales ratio. MasterCard and Visa trading at 15 together. Shopify trading at 11, and then something like a Block, or what was called Square, and PayPal, they're trading around 3 and 4. And obviously PayPal is not growing at the rate SoFi is growing, and also not Visa and MasterCard. So I do think that we do have quite a good number here with a 6 price to sales ratio. Seems to me like quite a deal at these levels. So I'm definitely, I have been piling into the stock over the past months, even before that, because I saw that potential which they had, gaining that additional banking charter and just doubling up their EBITDA. So that the numbers sometimes, when you look at the price to sales ratio, and it's a 10, right? But if you know already those factors that are gonna impact the stock going forward, then obviously you can make these adjustments to the metrics that are there at the moment, because it's just not that easy. If a bank charter can double your EBITDA, then obviously you need to impact that into your calculation and not just look at the metrics as is, as they are at that moment. You need to factor in all these sorts of impacts. And I think that the market had tried to factor it in a few times in the past few months. And when it always came back up, when on the news or on the anticipation of the bank charter. But then when it actually happened, the stock obviously also went up after market. But the macro factors were just so strong that they were pulling down and discounting these high-tech fintech high growth names. So I think that's the overall issue why we haven't seen SoFi gaining more and more as their revenue has grown, as the EBITDA margin has improved, and as they have actually gained the bank charter license. So all positive news for the last few years, for the last couple of years, but the stock has just not reflected that. And I think for the long-term investor, for the patient long-term investor, this is going to play out. I'm definitely bullish on SoFi as such, and I'm happy and excited to see how this is going to play out. So let me know in the comments below if you are invested in SoFi or what you're doing right now. Have you been buying at this? Have you been looking at this? And see you next time.